Welcome to Hibiscus Petroleum's Financial Results Webcast. This webcast presents an overview of the results reported as part of our quarterly financial report for the 3-month period ended 30th June 2020 and released earlier today. This webcast has been prepared by Hibiscus Petroleum Berhad, or the company, solely for general information purposes and shall at all times be heard and or viewed together with the full quarterly report for the same period that has been made available or published by the company on its website. This webcast may contain forward-looking statements which are based on current expectations, beliefs, and projections about future events or matters. By listening to and or viewing the webcast, you agree to the limitations and notifications set out in the disclaimer section of this webcast. Our presentation today comprises 6 components. In Part 1, Uday Jayaram, our Senior Vice President, Corporate Development, will discuss the overall oil market outlook. He will also present the results of independent assessment of our reserves and provide an update on the reserves position of the assets not covered by external third-party reviews. In Part 2, Dr. Pascal Hoss, the CEO of Sea Hibiscus Petroleum Berhad, will provide an overview of performance at our North Sabah Malaysian producing asset. Goloka Ravi, Corporate Coordinator for the Anasuria asset, will provide an overview of and an update on developments at our UK producing asset, the Anasuria cluster, in Part 3. In Part 4, Uday Jayaram will then provide an overview of the status of the development project relating to the Marigold and Sunflower discovered oil fields located offshore in the UK continental shelf. In Part 5, Yip Chi Yong, or CY, our Chief Financial Officer, will present the highlights of the group's financial results for the 4th financial quarter ended 30th June 2020. Kevin Robinson, our Vice President Special Projects, will then conclude our presentation with some of our key messages for this quarter in Part 6. Should you have any queries, you may contact our Investor Relations team via the email address provided at the end of this presentation. I shall now hand over to Uday.
Hello, this is Uday Jayaram. I'm the Senior Vice President Corporate Development at Hibiscus Petroleum Berhad. Let me commence this presentation by providing you with a brief outlook on the oil market. Referring to this chart by Rystad Energy, it shows that the extension of OPEC Plus cuts in July helped to balance the oil market, resulting in the oil price stabilizing above $40 per barrel. Total demand exceeded the 90 million barrel mark in July 2020 and is forecast to be flat until October 2020. The end of the year will see another increase in demand, with stock draws expected in December 2020. This chart, also by Rystad Energy, shows the historical Brent price, together with the futures curve and their Brent base case projection to 2024. Based on their analysis, a recovery in oil prices is expected from early 2021 onwards, peaking around $70 per barrel in 2022. In the shorter term, the Brent flat price has been relatively stable since early July, despite a bearish sentiment around oil demand and a generally negative outlook on the macro environment. Rystad views this demonstration of relative stability in oil prices itself as a sign of strength. The Rystad model also currently projects that by the end of 2021, Brent oil prices are expected to exceed $50 a barrel. Given the volatility of crude oil prices caused by factors previously mentioned, the group undertook independent assessments of the reserves of various assets. Competent persons reports were prepared for the Anasuria and Marigold assets by Gaffney Klein and Associates Limited and RPS Energy Consultants Limited respectively, to provide independent assessments of the assets' respective oil reserves. Based on these reports, amendments have been made to our 2P reserves and 2C contingent resources positions. The chart on this slide depicts our updated net entitlements as at 1st July 2020. Our total net proven and probable reserves stood at 46.1 million barrels of oil, whilst net contingent oil resources stood at 63 million barrels. We are pleased to report that the values carried in our balance sheet of each of our key assets have remained largely intact. We also internally assessed the degree of uncertainty related to the future development of the Vic L31 license, located in the Bass Strait of Australia. We concluded that given the current market environment, a prudent decision would be to downgrade the classification of the discovered oil in the license from a 2P reserves categorization to that of 2C contingent resources. For reporting purposes, we annually conduct an impairment analysis on all our major assets, unless other unforeseen events trigger a more immediate and specific review. I'll now hand you over to Pascal to provide a business overview of our Malaysian North Sabah operations.
Hello, I am Pascal Hos. I'm the CEO of Sea Hibiscus Berhad. Sea Hibiscus is the holder of a 50% participating interest in the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract, or PSC. We're also the operator of this PSC. The remaining 50% participating interest is held by Petronas Carigali Sendirian Berhad. This is our first PSC in Malaysia, and our participating interest was acquired through a transaction with the Shell Group that was successfully completed on the 31st of March 2018. The table on this slide shows the operational performance of the North Sabah asset over the past 4 quarters. That is from the 1st of July 2019 until the 30th of June 2020. During the current quarter, North Sabah production facilities recorded an average uptime of 95%, with gross oil production roughly 8% higher than the previous quarter. Average OPEX per barrel for North Sabah for the current quarter reduced to $10.27 per barrel, primarily due to the increased oil production and lower OPEX in the current quarter. Furthermore, during the current quarter, we conducted 1 crude oil offtake with a total of approximately 249,000 barrels of crude oil, net to Sea Hibiscus, being sold at an average realized price of $31.79 per barrel. One further offtake initially planned for the current quarter was deferred to the next quarter to realize potentially higher oil prices. Overall, despite the lower oil prices, we are pleased with our operating performance for this quarter. Given current production performance and barring unforeseen circumstances, we target to deliver approximately 8 crude oil offtakes from our North Sabah asset for financial year 2021. In normal circumstances, for each offtake, approximately 300,000 barrels of crude oil net to Sea Hibiscus is sold. As previously disclosed, in order to mitigate risks of business continuity caused by a low oil price environment during this period of uncertainty, we had entered into a contract in April 2020 to sell 750,000 barrels of crude oil at an average price of $35 per barrel, to be delivered during the remaining period of calendar year 2020. Referring to the projects shown on this slide, the SF30 Waterflood Phase 1 project development plan was approved by Petronas in October 2019, with water injection having commenced in June 2020. Phase 1 of this project is intended to assess the long-term viability of a full field water injection development project. It entails the drilling and completion of 1 infill water injection well through a new conductor, with the goal of scoping out the effectiveness of water injection as a means of repressurizing and providing long-term reservoir pressure support for the SF30 field. Total capital expenditure for Phase 1 is budgeted to be approximately 54 million ringgit and is being shared equally with our joint venture partner. We've also commenced our 2020 drilling program. On 26 June 2020, Petronas approved the plan for St. Joseph Minor and Major Sands redevelopment. This drilling campaign comprises 4 infill wells at the St. Joseph field, with 3 wells targeting the Minor Sands and 1 targeting the Major Sands. The first well spudded on 7 July 2020. Total capital expenditure for this program is budgeted to be approximately 214 million ringgit and is being shared equally with Petronas Carigali. Our plans for 2020 are consistent with our objective of enhancing production from the North Sabah asset and demonstrates that Malaysia is an integral part of our long-term growth strategy. In July 2020, we received a Focused Recognition Award from Petronas in relation to our 2020 drilling campaign. This was for the successful delivery of the St. Joseph Minor and Major Sands Field Development Plan, or FDP. Petronas acknowledged that we demonstrated strong commitment and a determined effort to review the St. Joseph OPEX and pledge to reduce cost. They further recognized that our actions have led to the timely delivery of cost-effective reserves monetization. In August 2020, at the inaugural Malaysia Upstream Awards 2020, we were honored to win 3 awards for our operating performance in calendar year 2019. These were Best Emerging Petroleum Arrangement Contractor, Gold Award in the Wells Excellence category, and a Bronze Award in the Drilling Excellence category. We are very proud of these awards as it is evidence of the hard work put in by everyone in the company, together with our JV partner Petronas Carigali. We continue to work towards aggressive production targets and the relentless pursuit of cost optimization opportunities without compromising the high health and safety standards that are expected in our industry. Golica will now take you through the details of the Anasaria cluster, which is located offshore the United Kingdom, in part 3 of this webcast.
Hello, I'm Goloka Ravi. I'm the corporate coordinator for the Anasaria asset. I'll now take you through some updates on the Anasaria cluster. In Anasaria, the average uptime achieved for the current quarter was 89%, while the average daily oil equivalent production rate was 2,861 barrels of oil equivalent per day. The offtake initially planned for the current quarter was deferred to the next quarter. This offtake was conducted in early July, and 250,337 barrels of crude oil net to Anasaria Hibiscus UK were lifted and sold. We achieved an average OPEX per barrel of oil equivalent in Anasaria for the current quarter of $14.29. This represents a small reduction when compared to the same metric for the previous quarter. This relatively low OPEX was driven by a combination of a reduction in the cost of oilfield services due to the lower oil price environment, a deferral of maintenance activities to mitigate COVID-19 risks, as well as an overall optimization in the timing of maintenance activities for the calendar year 2020. Operationally, a significant review of our operating strategies, maintenance systems, and organizational capabilities ongoing as part of an overall initiative to carefully manage costs. The performance of the wells is also being actively monitored, and efforts are being continuously expanded to optimize production. We are currently on track to achieve our target of reducing the OPEX per BOE to USD 18.5 per BOE over calendar year 2020. Planning also continues for 40-day offshore turnaround of the Anasaria FPSO. This is expected to be executed in the second half of 2021 financial year. Several minor production enhancement projects are also included in the planned scope of this turnaround. Whilst planned maintenance initiatives affect operational performance, these activities are critical enablers of a safe working environment and overall generally leads to an improved performance of the offshore facilities. Given our current production performance, we target to deliver approximately 4 crude oil offtakes from our Anasaria asset for financial year 2021. In normal circumstances, for each offtake at Anasaria, approximately 250,000 barrels of crude oil net to Anasaria Hibiscus is sold. Barring unforeseen circumstances, these measures, together with the production enhancement projects described on the next slide, are expected to improve the operational performance of the Anasaria asset. Referring to the projects itemized in the table on this slide, no major capex is planned for calendar year 2020. For the subsea debottlenecking project and future infill wells, the subsurface studies and technical assessments are currently ongoing, and further disclosures will be made as these projects progress. I will now hand over to Uday, who will give you an update on the Marigold and Sunflower assets.
Hello again, this is Uday. I will now briefly take you through the key points of our interests in blocks 15/13A and 15/13B. These are development assets which are located in the United Kingdom. This slide shows the target timeline of the Marigold and Sunflower fields as we achieve key milestones towards our first oil objective from these assets. We purchased interests in the blocks in which these fields are located, and based on reports from third-party competent experts, they contain 24.9 million barrels of 2C contingent resources net to the group. A schematic of the development concept is shown here. The development concept is currently being optimized, and once finalized, our next key milestone will be the securing of OGA approval for the Field Development Plan, or FDP. After the OGA approves the FDP, we will pursue the realization of the Final Investment Decision, or FID, for this project. Post-FID, we may farm out some of our interest in the Marigold and Sunflower assets as we execute the project towards the achievement of first oil. Given the current COVID-19 situation, it is likely that Project FID will now be sought in 2021, with first oil targeted for 2023. We are extremely excited by the potential value to be derived from the Marigold and Sunflower fields. We see this asset as a game changer for the group, introducing a step change to our daily net oil production rate. It will also establish the group as a mid-size E&P player. I will now pass you on to CY, who will take you through the financials of the group for the current quarter.
Hi, I'm CY, the group's Chief Financial Officer. I will now take you through the financial highlights for the quarter. Management periodically assesses the values of the assets carried on our balance sheet to ensure that a true and fair view of the financial position of the group is presented. As part of this process, our asset, technical, and petroleum economics teams rigorously test the inputs that support the carrying values. From time to time, independent assessments of our assets, conducted by reputable third-party competent persons, are also a source of the inputs used. These inputs are derived from, but are not limited to, assumptions or views on the long-term oil price curve, operating costs, development expenditure plans, and the interpretation of datasets from reservoir and geological models. Subsequent to the assessments conducted during the current quarter, the group recognized provisions for impairment on the carrying values of its oil and gas assets amounting to 196.3 million ringgit. Firstly, intangible assets in Australia, namely the WIG P57 exploration permit and the WIG L31 production license, were impaired by 183.5 million ringgit. Of this, 107.7 million ringgit was for WIG P87, with the remaining 75.8 million ringgit for WIG L31. This impairment has been made as we feel there is some uncertainty on the timing as to when we will develop our assets in the Bass Strait of Australia. One realization of the COVID-19 pandemic has been that with severe travel restrictions imposed, it is important that our investments are focused in areas where we already have a strong operational or project execution presence. These geographies currently are Malaysia and the United Kingdom. Secondly, up to the current quarter, the group had capitalized 4.2 million ringgit of its investments in license number P2366 in the United Kingdom, representing the amount paid by the group in connection with the investment thus far. Following an assessment of the investment, a provision for impairment for this amount has been recognized. Whilst this opportunity is linked with the overall development of the Marigold and Sunflower asset, we are unsure when we will be able to develop the crown discovery that lies within the license. Thus, we have elected to be prudent at this stage. In addition to this, as at 30th June 2020, the group further impaired the Britannia rig by 8.6 million ringgit. The ownership and potential utilization of the Britannia rig is linked to the development of the Australian Bass Strait assets. After careful consideration and assessment, the group concluded that there is uncertainty in timing related to the anticipated utilization of the rig within the group's planned production-related activities. Following this, the group entered into an agreement with a third party to dispose the rig. Documentation relating to this transaction was signed after the end of the current year. The recoverable amount retained in the balance sheet as at 30th June 2020 was based on the agreed sale consideration for the rig. Please note that both of our producing assets, namely the North Sabah PSC and the Anasuria cluster, did not require any provision for impairment. Sea Hibiscus became the operator of the North Sabah PSC on 31st March 2018. Accordingly, the current quarter represents the 9th quarter that North Sabah business performance data under the operatorship of Sea Hibiscus is being reported for detailed analysis. During the current quarter, the North Sabah asset recorded revenue of 36.7 million ringgit from the sale of 249,000 barrels of crude oil, net to Sea Hibiscus in one offtake. Average realized oil price achieved was $31.79 per barrel, compared to $47.72 per barrel in the previous quarter. Gross profit margin remained reasonably high at approximately 44%, despite the relatively low average realized oil price due to the careful management of costs. The decrease in OPEX per barrel from $13.05 in the previous quarter to $10.27 in the current quarter was primarily due to the achievement of higher production levels and the realization of lower OPEX in the current quarter. Average gross oil production improved compared to the previous quarter, increasing by around 8%. Additionally, average uptime in North Sabah in the current quarter of 95% was higher when compared to 89% in the previous quarter. Moving on to the computation of the EBITDA metric, the group completed the North Sabah acquisition on 31st March 2018. As part of the terms for the acquisition, recoverable costs incurred by the sellers as part of the executed work program, but not yet recovered as of 31st March 2018, are payable subject to oil prices reaching certain thresholds in calendar years 2018 to 2020. As at 31st March 2018, the group had provided for the amounts based on the assumption that the estimated future oil prices would meet the agreed seller thresholds for the respective calendar years. Following an assessment on the back of the recent drop in oil prices, C. Hibiscus has concluded that it is highly improbable that the oil price threshold set for calendar year 2020 will be met, and as a result, accruals amounting to 78.2 million ringgit was reversed as at 30th June 2020. This reversal has contributed to our earnings before interest, taxes, depreciation, and amortization, or EBITDA, for the North Sabah asset to be reported at approximately 99 million ringgit for the current quarter compared to 65 million ringgit in the previous quarter. The tax regime under which Malaysian oil and gas activities are governed and is thus applicable to C. Hibiscus is the Petroleum Income Tax Act 1967 or PITA. The provisions of PITA are applied to net taxable petroleum income at a rate of 38%. The North Sabah segment recognized a net tax credit in the current quarter amounting to 3 million ringgit, subsequent to a reassessment of the full financial year income tax obligations. The tax adjustment in the current quarter, when accumulated with the accruals made in the first 3 financial quarters of the current year, represents the best estimate of total tax obligations for C. Hibiscus for the current year. Turning to the Anasuria Hibiscus segment in the United Kingdom, loss before interest, taxes, depreciation and amortization for the current quarter was approximately 6 million ringgit, as compared to an EBITDA of approximately 41 million ringgit in the previous quarter. Revenue recorded in the current quarter amounted to 1.8 million ringgit, compared to 54.8 million ringgit in the previous quarter. Revenue in the current quarter was derived solely from the sale of gas, as the crude oil offtake originally planned for the current quarter was deferred to early July 2020, when Anasuria Hibiscus UK sold 250,000 barrels of crude oil. In the previous quarter, 239,000 barrels of crude oil net to Anasuria Hibiscus UK was sold at an average realized oil price of $50.59 per barrel. Average OPEX per barrel of oil equivalent in the current quarter improved to $14.29 as compared to $14.92 in the previous quarter. Consistent with the preceding quarter, a combination of an optimization in costs due to the lower oil price environment, deferral of activities to mitigate COVID-19 risk, as well as the optimization in timing of one-off maintenance activities in calendar year 2020 have all contributed towards the achievement of a low OPEX per barrel of oil equivalent metric. For the current quarter, loss after tax incurred by the Anasuria Hibiscus segment amounted to approximately 21 million ringgit. In the United Kingdom, the total tax rate for Anasuria Hibiscus is 40%, which consists of a ring-fence corporation tax and a supplementary charge at 30% and 10% respectively. A net tax credit of 6.1 million ringgit was recognized in the current quarter, as compared to a net tax expense of 2.9 million ringgit in the previous quarter. The net tax credit in the current quarter arose following a reassessment of income tax obligations on actual current year's taxable income, including the impact of the deferral of the crude oil offtake to July 2020. Whilst profits are extremely important, management's focus remains on delivering strong and sustainable EBITDA levels as long-term business continuity is of the highest priority. Our business performance is underpinned by several factors, predominantly the price of the Brent crude oil benchmark at approximately the time of a scheduled offtake from our crude oil storage facilities. Given that the oil price is affected by global macroeconomic factors which are not within the control of the company, focus is placed on the operational performance of the assets, such as production rates and facilities availability, as well as the management of operational expenses. A key metric that we utilize to track our operational performance is average unit production cost. The average unit production cost for both the Anusyria cluster and the North Sabah PSC are well below the average realized oil price achieved in the respective quarters. The careful management of costs to maintain low operational expenditure and the delivery of production enhancement projects are key towards obtaining a low unit production cost structure. This is a significant contributor towards our profitability. We wish to reiterate that management's focus remains on delivering strong and sustainable EBITDA levels, as long-term business continuity is of the highest priority. Over the past few quarters, our balance sheet has been gradually strengthening, more so with the introduction of the North Sabah asset as part of the group's overall business portfolio since 31st March 2018. We have built our total assets to approximately 2.4 billion ringgit, and shareholders' funds stand at about 1.2 billion ringgit. Included in shareholders' funds are retained earnings of 358.1 million ringgit. Year on year, both total assets and shareholders' funds have remained fairly consistent. The provisions for impairment for oil and gas assets recognized in the current year have been largely offset by net earnings generated from both the Anusyria and North Sabah assets. Net assets per share currently stands at 77 cents. As at 30th June 2020, the group's unrestricted cash balance stood at 77.3 million ringgit. The restricted cash recorded in our results relates mainly to a security for our portion of the estimated cost of decommissioning the facilities of the Anusyria cluster. In this regard, we are required to periodically place monies into a trust, and this commenced 18 months after the completion date of the Anusyria cluster acquisition. This activity will continue until such time that the security has been fully provided. In January 2020, the group drew down a short-term term loan for working capital requirements. The amount was fully repaid in July 2020 as per the agreed schedule. In April 2020, the group signed a deed of supply and collaboration with Trafigura, which covers several areas of commercial cooperation. The agreements with Trafigura form part of an overall plan to ensure that all planned projects across the group are fully funded over the 2020 and 2021 calendar years. With the volatility seen in the markets over the past few months, we understand that lending banks are having to safeguard their existing client portfolios and may require some time before onboarding new clients once again. In this period, however, we will continue to engage with financial institutions and industry players to explore funding options and capital raising initiatives which run in tandem with our growth plans. Before we wrap up, I would like to hand over to Kevin to highlight a few takeaway points.
Hello, I'm Kevin Robinson, VP Special Projects. I would like to close this presentation with some key messages. As part of our business continuity plan, Hibiscus Petroleum has activated various measures to mitigate the spread and impact of COVID-19 within our organization, as the health and safety of our personnel remains of utmost importance. Whilst crude oil prices may currently be low, our production remains online, and thus we're able to produce 3.2 million barrels of oil safely and efficiently in financial year 2020, meeting our target. In financial year 2020, we sold approximately 2.6 million barrels of oil. While oil production is a continuous process, our revenue is dependent on oil sales, which take place via offtakes in each reporting period. Given the prevailing low oil price environment, we elected to defer 2 offtakes in the current quarter, one each in Anusyria and North Sabah, to take advantage of potentially higher oil prices in later quarters. We implemented measures to optimize costs of both producing assets, with North Sabah and Anusyria reducing OPEX to $10.27 per barrel and $14.29 per barrel of oil equivalent, respectively, in the current quarter. At North Sabah, we have commenced the 2020 drilling campaign with the redevelopment of the minor and major sands of St. Joseph. A total of 4 wells will be drilled as we continue to focus on optimization of both our operating and development expenditure. The COVID-19 pandemic and low oil price environment initially slowed M&A activity globally in the first half of the year. However, with a ramp-up of economic activity globally, the outlook for the oil and gas sector is also improving. In addition, a focus on developing opportunities in the renewable energy space has caused established E&P players, particularly those headquartered in Europe, to assess their portfolios and restart their oil and gas divestment programs. As an organization, Hibiscus Petroleum is focused on building scale in areas where we are already present. Priority will be given to assets where there is a strong production potential, coupled with cost optimization opportunities. In conclusion, we believe that the steps we are taking should protect our business continuity objectives in the near term, whilst our business development initiatives will provide us the opportunity to grow our asset base.
And that's all we have for this quarterly earnings webcast. Thank you for tuning in.